Welcome to The Explainer. Today, we're diving into one of the most wild corporate evolutions we've seen in a long time. We're talking about Hon Hai Precision Industry. You probably know them as Foxconn. Now, for decades, this Taiwanese manufacturing giant was famous for basically one thing, right? Assembling your iPhones. But looking at the raw data from this year, a massive, undeniable thesis is jumping right out at us. 2026 is the year this legacy consumer electronics assembler literally transformed itself into an absolute titan of AI server infrastructure.
Okay, let's dive into this, because it's a super provocative question that is fundamentally rewriting the global supply chain. Seriously, what actually happens when the manufacturer responsible for putting the world's most ubiquitous smartphone in your pocket decides to just completely pivot its core identity toward artificial intelligence? Well, as you'll see in the numbers we're about to cover, it triggers an absolute paradigm shift, and not just for Foxconn, but for the entire global tech ecosystem.
Here's our roadmap for today's explainer. We'll start with the great AI transformation, then look at their record-breaking financial growth. After that, we'll see how servers overtake consumer electronics, how they're investing in the future, the potential risks and bottlenecks, and finally wrap up with the market outlook and conclusion. Let's get right into it.
Section 1. The Great AI Transformation.
To really grasp the scale of this explainer, we kind of have to completely redefine who we're even talking about. Hon Hai is no longer just the iPhone company. Driven by this relentless, almost insatiable demand from major US cloud providers, they are pivoting hard. They're moving away from assembling pocket-sized consumer devices to building massive, room-sized AI server infrastructure. That is their brand new identity, and it's literally dictating their entire future trajectory.
Section 2. Record-breaking financial growth.
Think about this massive milestone. In July of 2026, Hon Hai reported unaudited consolidated revenue of a record 946.5 billion new Taiwan dollars. To put that into perspective, that's roughly 29.3 billion US dollars, which represents a mind-blowing 54.19% jump year over year. That marks the very first time their monthly revenue ever crossed that 900 billion threshold. And it gets even bigger. For the first 7 months of 2026, their cumulative revenue hit 5.589 trillion NT dollars. That's up almost 38% from the exact same period last year.
And the crazy part, the profitability is scaling right alongside that revenue. In the second quarter of 2026, their net profit jumped 35% year over year to a staggering, record-breaking 59.97 billion NT dollars. Or about 1.86 billion US dollars. This absolutely crushed average analyst estimates, which have been sitting way lower at around 58.8 billion.
You can really understand this explosive growth when you break down their earnings per share. Q2 EPS jumped from 3.19 NT dollars in 2025 all the way up to 4.27 in 2026. And listen to this final figure. The first half cumulative EPS reached 7.84. with total first-half net profit up 27% to over 109 billion NT dollars. So, why does all this math matter? Well, it proves this isn't just some one-month fluke, you know? We are looking at a sustained structural explosion in profitability.
Section 3. Servers overtake consumer electronics.
This shift basically builds a completely new corporate profile from the ground up. On one side, we have the old Foxconn, heavily reliant on assembling smartphones and consumer devices, obviously most notably for Apple. But on the other side is the new Foxconn. This version is defined by AI server infrastructure and a deeply entrenched, rock-solid partnership with Nvidia. Hon Hai is now actually the largest server manufacturer for Nvidia, assembling the incredibly complex data center systems that house those highly coveted AI accelerators.
Now, what's really interesting about this next point is the definitive, historic crossover it represents. In Q2 2026, the Cloud and Networking division, which includes all those AI servers and racks, surged to 51% of total revenue. Meanwhile, smart consumer electronics, the longtime home of the iPhone, dropped to just 29%. Guys, that is a massive 22 percentage point gap. For the absolute first time in company history, building AI infrastructure officially overtook consumer electronics as their main revenue engine.
To understand why this shift is happening so violently and so fast, we have to look at the demand side of the equation. This whole paradigm shift is being fueled by an unprecedented capital spending arms race. Alphabet, Amazon, Meta, and Microsoft are collectively earmarking a massive $725 billion in AI spending in 2026 alone. That is a literal tidal wave of capital. and it's flowing directly into the exact infrastructure that Hon Hai now builds.
Section 4. Investing in the future. Currently, Hon Hai holds over 40% of the global AI server market, which is huge, but they are actually targeting a full 50%. And to hit that target, just consider their aggressive capital expenditure timeline. In 2025, capex was 173.8 billion NT dollars. In just the first half of 2026, they deployed another 80.9 billion. Management is targeting over 30% capex growth for all of 2026. This money is aggressively funding next-generation AI racks, advanced liquid cooling equipment, and crucially, the mass production of the new Nvidia Vera Rubin platform in Q3, with those shipments slated to begin in Q4.
And to support that incredible sheer volume of production, they are heavily expanding their geographic footprint. I mean, this isn't just a Taiwanese operation anymore. These investments are heavily concentrated right in the U.S., specifically expanding R&D and production campuses across Texas, Wisconsin, Ohio, and California. They're also scaling up major facilities in Mexico, Vietnam, and of course Taiwan, just to ensure they can actually meet this insatiable global demand.
It's also worth a quick mention that while 2026 is undoubtedly an AI-driven story, Hon Hai is still diversifying. For instance, they have an 8-inch semiconductor fab over in Japan that's running at over 90% utilization, turning out power chips and microcontrollers. They're also pushing forward with electric vehicles, delivering the Model B in New Zealand and Austria, and launching the Kavira SUV in Taiwan. Actually, scratch that. While the EVs are cool, keep in mind their contribution to overall profitability remains pretty limited for now. Right now, it's AI that's absolutely paying the bills.
Section 5. Potential risks and bottlenecks. Now we have to look at the other side of the coin. I want to read this direct quote from Hon Hai's own corporate disclosures. It is necessary to monitor the impact of the volatile global political and economic situation. Operating a massive, highly complex manufacturing footprint across Taiwan, the US, Mexico, and Vietnam inherently exposes the company to some serious global trade disruptions and highly unpredictable geopolitical vulnerabilities. You just can't ignore that.
Let's methodically break down these multivariable challenges, because they are significant. First up, structurally thin margins. Despite their operating margins improving slightly, their gross margin actually fell to a razor-thin 6.12% due to this product mix shift. Second, the CoWoS bottleneck. TSMC's advanced packaging constraints could severely limit the actual chip availability Hon Hai needs to finish their server racks. Third, as we just mentioned, geopolitics and volatile trade disruptions. And fourth, the overcapacity debate. If this crazy AI cycle moderates even a little bit, this massive infrastructure build-out could eventually outpace actual market demand.
Section 6. Market Outlook and Conclusion.
So what does this all mean for the street? Well, the crucial point is this. Despite the very real risks we just covered, the analyst outlook remains highly optimistic. The consensus rating right now is a solid buy, with a 12-month average price target of $22 for the GDR, which represents an upside potential of roughly 34.56%. Barclays even recently raised its target from $21 to $22, maintaining an overweight rating, and that's all based on expectations of a really solid 15% annual earnings and revenue growth trajectory over the next several years. I want to leave you with this final, provocative thought. Hon Hai has unequivocally proven that its pivot to AI infrastructure is a massive success right now. The record revenues and that shifting product mix totally confirm it. But the ultimate question remains. Can the AI cycle sustain this explosive growth beyond 2026? Their true test in the years ahead will be whether they can maintain this immense volume while successfully expanding those razor-thin margins. Thank you so much for diving into the data with me on this explainer, and keep learning.